Everyone, and welcome to the Daily Finance Wrap. This is your daily dose of all personal finance updates from insurance, loans, real estate, and everything that's related to your money. We've also got expert analysis on the show today, and do remember, we are live on YouTube. So if you've got any questions or queries, we've got the comment section. Do keep posting your questions, and we will attempt to get them answered. I'm your host, Avan Dabash, and hope that we equip you with all that you need to know about your personal finances. All right, we've got lots lined up today on the show. We'll be deep diving into our chat with our expert, but before that, lots of other top stories that we will be tracking today. And first up, the market regulator SEBI, on a circular on the 15th of October, has come out where they have raised the position limits for trading members cumulatively for client and proprietary trades in index futures and options contracts to 7,500 crore rupees, or 15% of the total open interest in the market, whichever is higher. The position limits will be calculated on the notional value of the contract, and earlier it was 500 crores or 15% of the total OI in the market. To the other top stories then, and Jefferies has gone ahead and downgraded the stock of BSE to underperform in the near term because they believe that the risk reward is not looking favorable at the moment. They've downgraded the stock to an underperform from a hold rating, although they have upped the target price, so 3,500 rupees a piece from the earlier target price of 2,850. Remember, we have seen a recent run up in the stock price of BSE, and that's largely been fueled by expectations of market share gains. The stock has incidentally risen over 100%, more than doubling since the release of SEBI's new F&O framework. However, in trade today, the stock price of BSE sure came under pressure, cracking nearly 5%. In other news, you had the markets which came under pressure, second straight day on the trot, so the 25,000 mark was not sustained by the Nifty. You can attribute this to the fact that there has been pressure coming in from the global indices, the inflationary concerns, and even the kind of Q2 numbers that have been coming in. They've not been too encouraging. So that's been a bit of a concern for market participants. In fact, when it comes to the overall market capitalization of the listed BSE companies, that got wiped out by nearly 1 lakh crores in a single day. We held above the 25,000 mark for the Nifty very briefly while we wrapped up a smidge below that level in trade today. And all eyes were on the mammoth IPO, that's the Hyundai Motor IPO, and the initial public offering on day 2 was subscribed 37 times. The initial share sale has received bids for about 3.7 crores as against the 9.9 crore rupees that was offered according to BSE. The portion for the retail investors, well, that was subscribed by about 38%. The quota for the non-institutional investors, that got a 23% subscription. The qualified buyers got a subscription of 45%, and the employee portion was subscribed about 1.3 times. Meantime, in other updates, the PFRDA has introduced the Balanced Life Cycle Funds under the NPS, or the National Pension System, where subscribers now have another investment option to choose from in addition to the existing active and auto asset allocation choices. So this is going to provide automatic rebalancing of assets, which is equity, corporate debt, and government securities, as per the age and as per the risk profile of the investor. The maximum allocation to equities under the fund is about 50%, which is available to those up to the age of 45. The corporate debt allocation will be about 30%. The GSEC scheme exposure is 20%. And post this age, the equity allocation will start tapering gradually, and it will be capped at 35% for those over the age of 55. All right, that's keeping you up to speed with all of the top stories and the headlines in the world of the markets and personal finance. Let's now welcome our market guest today. And we have a market vet, none other than Mr. Sunil Subramaniam joining in, and he'll be discussing today equity investment, and especially for newbies via the mutual fund route. Welcome to the Daily Finance Wrap, Sunil. Good to have you on board. Let's just get chatting about the markets in in-depth detail, and I want to understand your take. We've seen an 11-month stock rally, and that really now seems to be hitting the pause button, or seems to be, tapering off. So for new investors, what do you suggest? Is this a good time to invest?
There's never a bad time to invest. Let me start off by saying
The
that.
optimist, aren't you, Sunil?
But then, yes, new investors, because there's so much news flow around, oh, India is expensive, overvalued, there's so much geopolitical risks around. I can understand where this question comes from. So, from that point of view, I just wanted to reassure them about one thing, right? All the volatility in the market in the recent days, right? You mentioned 11-month rally. All the
Yeah.
volatility that's happened is non India related, in the sense that it comes from geopolitics, it comes from the Fed rate cut, it came from the yen carry trade. So there's a lot of stuff happening outside, and for the next few months, likely to be there because there's the U.S. elections coming up. We don't know which way the Lebanon, Iran, Hezbollah war is going to progress. So some degree of nervousness in market participants is causing this volatility. Second point is that remember that for an FII, India is a stock. So each stock goes through a valuation, a P/E ratio, and there's one for India as a stock. And China, because it's been so beaten down in terms of negative news, has dropped to all-time lows. So some amount of people are looking at the valuations and putting money into China, taking money away from India temporarily. So I would say that this is actually a good opportunity for investors to enter when there is volatility, because in the long run, none of the stuff that I mentioned is going to alter the fact that India is headed for a decade of high, medium to high nominal GDP growth. So just hear the word nominal there, it's GDP plus inflation. So if we all know we are growing at about 7%, inflation is hovering at around 5%, so that's 12%. But as the years come by, India's GDP will go up by another couple of percentage points and inflation will probably remain here. So about 14-15% is a nominal GDP growth, and markets over the medium term generally reflect that in their returns. So I think that for new investors, alternatives in bank deposits are giving 8%. Tax advantages are still live with the mutual fund equity investments. So it's a good time to enter the market, provided you have a medium term time frame in your mind.
Yeah, I think that's key, that you have to have a long to medium term time frame in mind if you're looking at the investment opportunity in equities. But Sunil, if we were to get into it, and I'm sure a lot of new investors have this question on their minds, what are the advantages of choosing a mutual fund over investing directly in the stock markets? Especially if you're an investor, time and again, you may get a little bit tempted. Why not just deep dive into the stock markets? XYZ made so much money, so why don't I do it myself? But there are a lot of inherent risks that come with it. So, what is the major advantage of looking at equity mutual funds instead?
So I think the first thing is that remember, when you're buying a stock, you're buying a company. So when you're buying the company and its business, that company's survival growth is dependent on other competitor companies in that frame, right? So over a period of time, right, a lay investor has no idea, is this company going to be the winner? Take the telecom sector. Half a dozen years ago, you had so many players in India. There was Reliance Jio, there was Bharti Airtel, Vodafone, and then you had Aircels and a whole bunch of other players. Now, if you had tried to buy one of those stocks, would you be able to predict which was going to be the winner and then get out of the stock before the market came to realize that it was a loser? No way. So a mutual fund, what happens? They have research on their end. That's the first advantage, is that they get to knowledge well before the lay investor. They study the future. They get international knowledge to know how this is going to happen. But more importantly, a mutual fund also never puts all his eggs in one basket. He diversifies. So to the extent that from a stock portfolio, you would find it very hard to diversify across the Nifty 500 companies. How many will you choose? Which sectors will you choose? But that's where the mutual fund manager, because of his experience and his training, combination of expertise and diversification. Expertise helps you pick the winner. Diversification helps you protect yourself from picking a loser, right? Because if you put all your eggs in that terms, be a loser, you'll lose money. So I think these are the two clear reasons why individual stock investing will always be inferior to a mutual fund investment. People who trade in F&O, the stock market, they are gamblers. Let's leave them out of the picture.
Yeah, absolutely. Gamblers. And that is the last thing you want to be in a market, especially with all of the risk that is associated with it. But just curious to get in your take as well, Sunil, when it comes to overall looking at equity mutual funds, a novice investor, what would be your advice to them to assess the risk tolerance before investing in equities?
So I would say if you go to an advisor, he'll always have a model where he'll be able to judge it perfectly for you. But even otherwise, a small look at your life, right? I'm just saying that we face failures at every moment in our life, in our normal situations, right? How do you handle that failure? If you get very worried and it kind of freezes you from taking the next action in your life, then your risk tolerance is very low. The smallest things tend to affect you mentally. Whereas if you're a guy who looks at this failure as a stepping stone and says, okay, that happened, I learned from it, move forward, then it means that you have the goal in mind and you're willing to absorb these small failures to go to success. Stock market is very similar. Nobody gets everything right all the time. There will be times when volatility makes you to lose money in the stock market temporarily. Do you have the strength of mind to stick through that period and go past it? Then ultimately the nation's growth will come into your portfolio. So I think that the key there is to assess how you are as an individual. But if you want a more professional way, just go to a registered investment advisor or a distributor, and they'll be able to do your risk tolerance for you. But this simple thumb rule, I think, serves you very well.
Okay, fair enough. I think that's a thumb rule that people need to really take cognizance of. Now, we continually hear of active and passive mutual funds. And Sunil, for a newbie investor, what is going to be the preferred route of investment? And if you can just elaborate a little bit more as well as to what active versus passive funds
Yeah.
are.
So there's a lot of indices in the market. There's a Sensex, there's a Nifty 500, and then you have various sectoral indices. When a fund just copies an index, it's an index fund, or you have an ETF which buys the same stocks in the index. That's called passive, because no human brain or fund manager's intelligence or anything is coming to apply itself to selecting the stock. Whatever comes into the index, and the index is formed by rules. There are market capitalization, free float, various rules which the index provider has, and they create the index. Now, what the index means is that you're buying the market, which means, but over a period of time, the constituents of the index can change, but your portfolio will automatically change with that. So if as an investor, you just want to be in the stock market for an inflation beating return, a passive investment will serve you well, right? Now, what's the difference between passive and an active fund manager? While he has the index as his benchmark, can buy more or less of the stock in its weightage. He can buy a stock outside of the index, right? Now, for that, he charges a fee. So the first thing is that active funds are a little more expensive than passive funds. So when a new NB looks at, oh, he says this cost is more, but that cost is generally half to 75 basis points more, whereas you're talking of a base of return of 12 to 15%. So as you can see, as a percentage of your return, that cost differential is not great. But even so, even then it worries you, then why should you choose active? The reason I'm saying you should choose active in your thing is because if you want to get better returns than just the market, then there's a whole bunch of fund manager and professionals who've been through courses, who've done their CFA, MBAs, who are studying the market, bringing their knowledge and intelligence to bear, number one. Number two is the scope of diversification. So you take many of the indices, even the Nifty, for example, has a 35% concentration in the banking sector. So as a passive investor, you tend to get a higher concentration sector, whereas a fund manager would balance it out. And that's where diversification comes into play. So again, coming back to very similar answer to the first one, expertise plus diversification of an active mutual fund, according to me, more than compensates the cost of that. And so if you are really looking to take advantage of the stock market to build your future wealth, I would say that active funds are the way to go. There's another reason for that, which I will also tell you, is that you're a novice. Yeah, you're a newbie. You don't know anything about the market. But if you put it in the index constantly going to change. You're not going to end up learning anything. But if you go into an active mutual fund, you can actually get the portfolios every month. The fund managers do calls every month. You can understand why he bought and sold a stock. How did he change? And your knowledge as an informant. So if you want to become an intelligent and smart investor, active funds will help you along that process.
Okay, so active, mutual funds it is, and Sunil has really elaborated as to why that should be the preferred option, especially if you're a new investor. Now, I'm sure investors across the board make some classic mistakes. So, you have been in the market for so long, Sunil, and I'm sure you've identified them. So, when investing in equity mutual funds, what are some of the common mistakes that investors made, and more importantly, how can they avoid them?
So I think the first and basic mistake that happens is that you blindly choose past performance as your filter to choose a fund. Now, it's not that a fund which delivered good past performance will not deliver in the future. The problem is that combined with that past performance, you tend to go for the highest return fund, right? So when does a fund give a highest return? Typically, this happens when there are cycles in play. When the cycle is riding its wave, they far outperform the market, and investors tend to go into these sectoral thematic funds, a defense opportunities fund, an infra fund, right? So those they enter when they have delivered something like the 40-50% per annum. But the life is full of cycles, which that what goes up must come down, and that which has gone down will come up. So investors make a point of entering these cyclical funds at the very peak and then suffer a massive series of losses. So what is the best way? The second is, even in normal diversified funds, there are times when the market goes up and market goes down, right? So the best way to manage this is if you can access, and it's available in various sites, something called as a rolling returns analysis. A rolling returns analysis, which puts your money in every day in the market and see how the fund has performed over a period of time, will tell you how well did the fund do when the markets were roaring, and how well did it protect you when the markets were bad. So you should choose a fund which doesn't lose you so much money when the things are bad, but maybe there's a price for that. You give up some of the gains when it's up. That's the ideal way to choose a fund, rolling returns analysis. So typical the mistake is to enter at the wrong time and enter the wrong type of fund at the wrong time. Rolling returns analysis helps you then to take away those triggers and then choose the right long-term fund for you to invest.
Okay. What about diversification? We keep hearing about that, but I think experts cannot stress enough on how important it really is. Why do you think it is important, Sunil, for especially first time or beginner investors?
See, the beginner investors always see the kind of fantastic returns a particular stock gave, and they would like to put all their money into the stock. At that time, a stock has given 70% return over the last 6 months. They look at a 30% return and say that's a 40% less for me, so why should I choose? The temptation is always either choose only the best performance or overload on that, right? So typically what happens is, like I said, life is full of cycles, and things which go up, what's going to go up in the next cycle, nobody can give a perfect answer, right? So in financial risk theory, there's the theory that which says that up to 20 stocks, right, if you add to your portfolio, you can actually reduce the risk, that is your losses, without giving up that much of the gain, right? Remember, there's no free lunch. So it's when you say reduce losses, you actually have to give up some of the gain to protect you. That's insurance premium. Diversification is nothing but an insurance premium. That's another way to look at it. So the purpose of that is to make sure that you get inflation beating returns, but at the same time, when markets are very bad, obviously now losses don't protect you from inflation, is to protect you from losses. So the key to diversification is there is something called the risk reward framework. How much of risk protection you want, for which how much of reward you're willing to give up. The best one, and that's where the ratio called Sharpe ratio comes in, is the reward per unit of risk, right? And what diversification does is it maximizes the reward per unit of risk. And this awareness of risk in people is very, very limited, because they only see the good points, and the bad points they tend to just get into their shell. So diversification is the best means of protecting yourselves from the worst times, at the same time making sure you get a healthy return during the good times.
All right. I'm so glad to see that we've got some viewer queries as well that have been sent into us in the comment section. So we're going to try and get them answered. First up, let's take on Ashish Kotian's question. And he asks, Sunil, how do the changes in SEBI's rules impact everyday traders like us?
Well, first of all, the very small trader, it makes life very hard for him. Second is that it's also the fact that you've got to realize that in trading, which is not very dissimilar from gambling, the house always wins. Like in a gambling, the gambling house always wins. They always make sure that they are never a net loser. There may be some people who are winners, some people are losers. Data from SEBI has shown that 90% plus of people in F&O trading and others have lost money. And the losses are not insignificant, right? So I think what SEBI's point of view in doing these regulations is to make sure that the people who are investing have a lot more money. That's why they've increased the ticket sizes, and all of their regulations are meant to protect the very small investor whose ideal choice should be to enter through a active mutual fund, understand, study, and later maybe come and dabble into stocks and futures and options and all of that. So I think what SEBI rules mean for you is that it's going to be much more expensive for you, because you will now have to concentrate your thing into a few larger things to do. So take your bets with care. Make sure that you are not putting all of your money into this. Keep a specific amount to trade in the market. You want to gamble, that's fine, but keep it to limits. Put stop loss limits and book profits limits when you enter.
Okay, I hope we got that question, Akash, answered for you. Let's move right on to the next viewer query. And do remember, guys, we're live on YouTube. So if you've got any queries that you'd like to ask us, please do write them in the comment section. All right, Vineet Patel has asked his next question, and he says, what are the factors that one should consider when we choose an equity mutual fund, especially given that the markets are so volatile?
So I think the first thing to consider is the long-term track record. I know there are a lot of new fund offerings that come up in very exciting new themes and all of that. But ideally, I would say that you should invest in a fund which has completed 10 years. And I'll tell you why. Because you need to evaluate a fund's past performance over a good cycle and a bad cycle. Now, we'll know in the last 10 years, the economy has seen through the global financial crisis, which occurred, of course, quite some years ago. But in the middle, you've had other crises, which has meant that the markets haven't done well. COVID, for example, the month. So for you to judge, I would say for a first-time investor, go for a 10-year plus track record. Second is, look at that funds. Don't look at the point-to-point returns. That is, it started 10 years ago. How is it doing now? Oh, has it beaten its benchmark? No, that's not good enough. You've got to say that take the calendar year returns of the index, take the calendar year returns of the fund. When the index has done badly, how much badly worse it has done? Has it lost more money than the index? And when the index did very well, has it made more money? So there is no easy answer, because there are many fund managers who have achieved the golden mean of losing less money than the index and making more money, but that's very rare. But by and large, a person's tolerance to loss is far, far less than his happiness when it's much gains. What I mean is 1 rupee of loss is equal to 10 rupee of gains, to put it very crudely. Right? So look at the fund saying, in bad times, how well it has kept my shirt on. That's the kind of fund you should put your money as an investor, because good times, everybody will participate to some degree, more or less. But the bad times, only the purely diversified, properly diversified portfolio will give you the protection. So just take these 2 points into consideration.
Yes, and stressing yet again on the importance of diversifying your portfolio. Vineet, thanks for that question. I hope we managed to help you out. Guys, do remember we have Sunil Subramaniam, a market veteran, live with us. So if you've got any questions or queries, do keep them coming. Why don't we take our next question then from Karunya? She asks, what is the best way for asset allocation for a new investor? Say that you're starting out with their first job. What is the best way to do asset allocation in such an instance?
So first of all, starting off in a new job, SIP is the best, because you're in a job, your cash flows are monthly. You're probably going to buy your car and your house on EMI. Those are monthly. Make your investments also through SIP on a monthly basis. In fact, you can probably reframe it as saying savings EMI, right? Because then you align the cash flows. You're not then borrowing to meet up a gap or whatever. You're aligning them perfectly. Second is choose a SIP in very different types of funds. Right? So you can choose a small cap fund, a mid cap fund, a couple of sectoral funds. So that diversification you can achieve by yourself in your portfolio, because a small cap fund you will diversify within the small cap space. But across the cap curve, you can choose. So choose a multiple types of funds which are very different from each other. Right? If you don't want to go through all of that trouble, there are funds which dabble, or I may say put their money into all the 3 cap curves. For example, there is flexi cap, there's multi cap, there's large and mid cap. If you don't want to take the trouble of choosing a larger basket of funds which are very different from each other, choose a multi-cap, flexi-cap, large and mid-cap, maybe 2 funds in each category, keep 6 funds in all. Put SIPs into those and make sure those SIPs run for at least 5 years, right? So that way you are able to see through at least part of a cycle in doing that. So I would say that's the SIP investing is the best way, because as you know, when you put your money in monthly, 2 advantages come to you. Your money compounds every month. They say power of compounding is the 8th wonder of the world, right? So that power of compounding comes into your money. The second is a very slightly more complex term called rupee cost averaging. It's very, very simple, right? What it tells you is that the market is down, you're putting the same money, but you're getting more units. So it's basically like, you want to buy your favorite brand, right? but there's a discount sale on the brand going. You know, you value that brand and you want that branded shirt, frock or whatever. But when it's a discount sale, you're getting the same thing for much better value, right? So like that, when the markets are down, because we know that ultimately in the long run, the economy's growth is going to translate into the market's growth. When things are correcting, like right now, when you invest through this, rupee cost averaging helps you to buy more of this good stuff at a cheaper price. So I would say SIP helps you to take part in the ongoing sales that happen in the market and not just a Diwali sale or a Ganesh Chaturthi sale.
Although that is coming up, the festive season, so that is going to be interesting. But yeah, I hope that answered your question. And do keep the queries coming in. We're live with Sunil Subramaniam. This is the Daily Finance Wrap. It's all things related to personal finance. We'd love to get your question answered. Well, maybe I'll come in with a question then, Sunil, just to break it down, because I think a lot of new or first-time investors, when they look at key mutual fund metrics, for example, what is it that they need to keep on top of mind, or how should they look at details like expense ratio, alpha, beta when evaluating equity mutual funds?
So I think first, I would say that to a first-time investor, he can actually not worry about these things, right? These are just noise, according to me, which for a more intelligent and more aware investor probably has some value. But in a first-time investor, don't clog your mind with this. Just diversify. Like I said, 6 funds to me spread across 3 or 4 categories is good enough. Just spread your risk and do that, right? Now, these things that you mentioned, right? The expense ratio. Let me take that one. The expense ratio, we are talking about the highest expense ratio of any mutual fund is 2.5, 2.25, 2.5%. The lowest expense ratio of an index fund will be 30 to 40 basis points, right? So you're talking about a difference of 175 to 200 basis points. So keep that in mind, that this cost, right, that you're doing is the price you're paying. Is the insurance premium the price you're paying for the expertise and diversification of a qualified fund manager, right? Now, when your returns you're expecting around the 12 to 15% mark, 1.5 to 2% is 10% of that cost. So 90% of the gains are with you. So overly worrying about expenses. Now, if you are deploying maybe 50 lakhs, 60 lakhs, that kind of money, then these small amounts of percentages make significant amount of your wallet. So then you look at it, right? So if you're deploying significant amounts of money and at the expense ratio, then index funds and passive funds are the lowest cost options. So those diversifying among a set of index funds or ETFs would serve your purpose. That's the best way to get your worries of the expense ratio, if really they are, you shouldn't be. Now, on the other ratios that you mentioned, Sharpe ratio, right, alpha, beta, all of these are various measures of risk. And we looked at risk earlier in this conversation. So the best way to manage risk, like I said, is diversification and expertise. I'm sorry, I'm sounding like a broken tape recorder today, but diversification and expertise are the 2 things which help you to manage downside risk. At the same time, not give up that much of upside returns. Simple. So these ratios are telling you which fund managers have done how. But at your initial stages, you don't need to worry. You can diversify among fund managers and take care of all these ratios at the time. Later, over a couple of years' time, once you've studied and understood these funds, how they change, what the ratios, you can then start adding this to say, which fund will I take more of because it's got a better Sharpe ratio. Those are all later in the stage. For a beginner, I would say don't put overemphasis on all these rich and other metrics.
Okay, fair enough. So I hope that helps our first-time investors with a lot of those pointers there. But just looking at the current economic climate that we're in, Sunil, there are so many types of equity mutual funds: large cap, mid cap, flexi cap, etc. So what type of equity mutual funds do you recommend to investors who are currently in this volatile environment entering the market?
So I would say that if you have a slightly more higher risk temperament, right? Today, there are a lot of sectoral themes. Over the last year and a half, the industry has brought a lot of sectoral themes into the market. So one way for you to do that is to choose contra-based themes, right? There's auto, there's IT, there's pharma, there's banking. So if you choose let's say half a dozen sectoral themes, but make sure they're not all the same. Like don't choose an auto and a consumer because they're from the same basket. Choose widely different, pick 5 to 6 thematic funds, put them in one basket. If you are aggressive, because some parts of those portfolio will go through sharp corrections, some will give you super gains. So you should have the mental equilibrium to handle that. But the weighted average return of your portfolio should take care if you have chosen contrasting themes. That's number one. However, if you're not that mentally strong to take losses or corrections, right? Then I would say there's a basket of cap curve diversified funds in the industry called the flexi cap, the large and mid cap, and the multi cap. What's the difference? Flexi cap largely has a lot of large and some mid. Large and mid cap has some large, some mid, little small. Multi cap has at least 25% in small, 25% in mid, and the balance 50% can be 25% minimum in large, and the rest spread over. So they obviously, when you go from flexi cap to multi cap, the risk level increases, but the return potential also proportionally increases. So choose again a basket. Again, 6 funds is my ideal. Choose two of these. Choose very different fund managers for those. Put them together. Then that will make sure that your corrections and your volatility in your portfolio is much less than a bunch of sectoral themes. But by and large, over a long period of time, they should serve your wealth creation potential very, very well. If you are very conservative in your philosophy, right, very, very risk averse, then there is hybrid funds. What they do, they blend debt into equity. So you have balance advantage funds, you have multi-asset funds where they add gold or other commodities to it. These are reducing risk much more, but obviously you give up some returns. So if your risk is conservative, so to put it slightly now, to summarize, aggressive, moderate, conservative. Aggressive, choose a bunch of diametrically different sectoral themes. If you're moderate, choose large cap, large and mid cap, multi cap, those category. And if you're conservative, choose hybrid funds like balanced advantage fund, equity savings schemes, and multi-asset funds. That should be the way you should go about constructing your portfolio based on your risk tolerance.
All right, Sunil, it's been a pleasure having you on board. Thank you so very much for sharing with us that advice for new beginning mutual fund investors. And I'm just going to sort of sum up what Sunil has advised us, that it's a good time to start investing in the markets right now and creating a diversified portfolio. That is very critical. You can also remember that you have to look at active in mutual funds. That's a better route to go by. And do remember that it's a constant play in the markets between growth as well as value. He also spoke about avoiding the classic mistake of going by past performance of mutual funds. And do remember, flexi cap, large cap, mid, and multi cap funds are some good categories that new investors can look at. All right, with that, we'll wrap it up and we come to the end of the Daily Finance Wrap. Thank you all so much for tuning in. Do remember, we go live daily at 6 p.m. on YouTube, so we hope that you tune in. Catch you tomorrow. Bye. It's done. Oh God, no, this is too stressful.